In this video, we will introduce you to spot markets and derivatives markets. Spot markets versus derivative markets. It is important to understand how we trade in the commodities market. The spot market. This is for immediate delivery. You pay cash and receive the physical goods now. What you need today, you buy today. The derivative market. This is the space where MCX operates. You trade a contract based on where the price will be in the future. This allows participants to manage price risk without needing a warehouse to store physical oil or metal immediately. Thus, if you need to buy or sell a commodity right now, you go to the spot market. If you want to manage or fix the price for the future, you use the derivative market. As we said just now, MCX is a derivatives market. Prices of all the traded commodities are quoted in terms of their futures price. Look at this ticker. It says gold 5th February 2026 rupees 150560. Means 10 grams of gold futures cost rupees 150560 to buy today, for which we will get the delivery on 5th February. Please note that while this contract is quoted for 10 grams, the minimum trading unit is 1 kg. The spot market price of 10 grams of gold is rupees 147088. You will see that the futures prices of all commodities are usually higher than the spot prices. Why is that? This is because of the concept of cost of carry. What is cost of carry? When you actually buy a commodity in the spot market and take delivery, there are various costs associated with holding the commodity. These include cost of storage, insurance, and transportation, cost of financing, since you are paying full money upfront instead of just futures margins, other costs associated with carrying the commodity until a future date. As you may understand, these costs will usually be higher if the futures date is farther away, and these costs will be lower on most occasions if the futures date is nearer. And finally, on the last day of the futures, also called maturity, spot and futures will almost be at the same price. This is called convergence. We will deal with the differences between spot and futures prices in much more detail in later videos on commodity futures. Now that we have a basic understanding of the types of commodities traded, let us look at a slightly different aspect: commodities as an important group in an investment portfolio. This is the topic which we will delve into in our next video.